All right, so let's apply the steps. Do we have a contract? All right. In this case, we assume, unless I told you something that made you very worried about there being a contract, we haven't really even dug into the issues of a contract yet, then we assume in this case, yeah, let's assume we've identified the contract. The contract is the purchaser, the buyer gives us $340. In return, they receive 2-year access and a console. Right? What are the performance obligations? We talked about that. These are separate and distinct as long as the console is not required for their multi-user system. If the multi-user gaming system is only accessible with a console, then these are not separate and distinct performance obligations. Right? Step three, determine the transaction price. This one, it's pretty straightforward. The buyer expects to pay 340. The seller, Myrmidon, expects to receive 340 for this package deal. Step four, allocating the transfer price. This is when the math starts coming in. So how do we go about allocating this? I usually just create a little bit of a table in order to keep the steps of the process separate. We have two performance obligations. PO1 is the console. Performance obligation 2 is the subscription. The first thing I need to establish is what are their standalone prices? This is the first step to allocating appropriately. We're going to use the standalone prices as a means of figuring out, well, how much of the transfer price, 340, should be allocated to performance obligation 1 versus performance obligation 2. So the standalone price of a console is $300. The standalone price of the subscription is 50 for a year, but they're getting 2 years in this package, so that's 100. Then altogether, if I bought these two separately, I would pay $400, right? So that's the total of the standalone prices. Now, we're going to allocate the performance obligation. We're going to allocate the transfer price of 340 to each of these performance obligations based on what proportion of the total price here does each performance obligation represent as a standalone price. So the standalone price or the proportion of the console's price to the total amount that's being offered in this package is 300 to 400 or 75%. The subscription represents 25% of the total package in its standalone price or 25% or 1/4. We multiply this by the transaction price. What does the buyer expect to pay? What does the seller expect to receive? In this particular package, it was $340, right? That was a simple piece. And now we allocate appropriately. If we apply 25% to $340, we get $85. And if we apply 75% to $340, then we expect $255. So this is the amount of 340. If we add these two together, they're 340. This is the amount of 340 that should be given to the console and then to the subscription. If we sold 10,000 of these, then we're talking about 2,550,000 for the console in total and 850,000 for the subscription in total. And again, this should total out to the total revenue we need to recognize here, which would be the transaction price times 10,000, the units we sold. All right. Well, now that we have the amount, let's assume that when we sold these, we received cash. It could be an account receivable. Doesn't matter. We either debit cash or debit accounts receivable. But let's assume cash, unless otherwise told. Cash for 3,000, sorry, 3,400,000. And now we have to decide when we receive this cash, can I recognize all of that as revenue? No, not quite, because this subscription is a period of time. So we'll recognize the console as a point in time, point of sale, and we can recognize that sales revenue immediately because we don't have any ongoing software updates to provide to it that are combined in the console's performance obligation or anything like that. And then the subscription would be deferred revenue because we have to provide access to our multi-user gaming platform. Now, this would be the initial entry. I receive cash, that's an asset. My income is increased from the sales revenue. And then I also have a liability from that deferred revenue that I have to provide the multi-user platform. Now, as time passes, let's say a year passes, with respect to these 10,000 units packages we sold, then we can now recognize half of the deferred revenue. So we debit the deferred revenue to reduce it. And now can recognize sales revenue from that performance obligation. We still haven't recognized it all. There's still a year left of service we need to provide. But when that occurs, we can then, the next year, debit deferred revenue again for 425, credit sales revenue again for 425 at the second year. And then all of this deferred revenue has been eliminated and in total recognized as sales revenue.